Hey everyone, and welcome to Talk Tickers. Today, we're digging into a really interesting one, Lument Finance Trust's latest earnings report. The numbers were, let's just say, messy. But management? They're telling us it's all part of the plan. So let's figure out what's really going on here.
So let's just rip the Band-Aid off right away. This was the number that just jumped off the page. -73%. An absolutely staggering figure that, immediately got everyone talking and put the company in a tough spot.
And what does that number even mean? Well, that's how much Lumen missed their distributable earnings estimates by. And for a mortgage REIT, that's a huge deal. We're talking they reported just 2 cents a share when Wall Street was looking for 7.5. So yeah, you can bet the market's reaction was not great. So this is the big question, right? How on earth can management look at a quarter like that and say, yep, that's part of the plan? They're trying to sell a story here, that this is just short-term pain for long-term gain. Our job today is to see if that story actually holds up.
All right, first up, let's get into the Q3 snapshot. We're going to look at the tail of the tape, the hard numbers.
Okay, so take a look at these results. It's not just that they missed, it's the scale of the miss. I mean, distributable earnings per share absolutely cratered, down 80% from last year. And their net interest income, that's their bread and butter, the engine of the whole operation, it got sliced almost in half. Even book value is ticking down. It was just a brutal across-the-board miss.
And no surprise here, the dividend got chopped again. That's the second cut this year, down to just 4 cents. And this right here, this really shows you the cash flow crunch they're in. Even after cutting it, those 2 cents of distributable earnings only cover half of it. So what they're doing is pretty clear. They're trying to reset everyone's expectations way, way lower.
So we've established the numbers are ugly. But why? Let's dig into the diagnosis and figure out what's really going on under the hood.
That big drop in net interest income wasn't just a single issue. It was kind of a 1-2 punch. On one hand, they were deliberately shrinking their portfolio, which means fewer assets making them money. But the real kicker was about $800,000 in what they call interest reversals. Basically, they had to go back and erase interest they'd already booked because some loans went bad and stopped paying. That's a direct hit from credit problems.
And here's a closer look at those problem spots. You've got about 10% of their loan books sitting in the highest risk bucket. Not great. They've also had to take back the keys to 4 properties. That's what REO, or real estate owned, means. And those are only about 73% full. So while they're trying to clean up this mess, they've also been reducing their debt, which just puts another squeeze on earnings. If there's a silver lining, it's that this is all in multifamily. They don't have any of the massive headaches you're seeing in office or retail right now, so there's that.
Okay, so this is where we get to the core of management's whole argument. They're basically saying, yeah, we know things look bad right now, but it's a necessary evil. Why? Because they're in the middle of a massive pivot in how they finance the entire company.
Now, you really got to pay attention here, because this is the entire bull case for the stock. It's a 4-step plan. Step 1, they got a big new credit line from JPMorgan. That gives them the cash for step 2, which is to pay off and get rid of their old 2021 CLO. A CLO, if you're not familiar, is just a way they bundle up their loans and sell them off. So why get rid of the old one? Well, step 3 explains it. That old structure was really inefficient and had a bunch of their equity trapped. Getting rid of it unlocks all that capital. And that leads to the final step, number 4, launching a brand new, much more efficient CLO. It's a pretty slick sequence, you have to admit.
And you don't have to take my word for it. Here it is, straight from the CEO, Jim Flynn. The message is crystal clear. Hey, we know the earnings look weak. That's on purpose. Their focus isn't on the next quarter's profit number. It's about cleaning up the legacy problems and setting up the financing structure for the long run.
So 88.1%. This number is the so what of that whole financing pivot. It's the advance rate on their new CLO. In simple terms, it's how much they can borrow against their loans. They went from 72% on the old one to over 88% now. That is a massive jump in efficiency. It frees up a ton of capital they can now put to work somewhere else.
So now we've got the 2 sides of the story. On one side, you have management with a pretty credible, sophisticated plan. But on the other side, you've got the market, which is basically saying, we're not buying it. And this creates a really fascinating standoff.
And this really lays out the 2 competing narratives perfectly. You've got management saying, don't worry, the credit problems are contained. The market's reaction?
the stock is down 37% over the last year. Management says, look at this new flexible financing. The market says, yeah, but you can barely cover your dividend after cutting it twice. Management points to a book value of $3.25. The market, it's trading the stock at a massive discount to that. It's a total disconnect.
And just how big is that discount? We're talking about the stock trading at roughly half its book value, 0.5 times book. That's the market screaming one of three things. Either that book value is fake and there are more losses coming, or they just flat out don't believe management can actually pull this plan off and get earnings back on track.
You can actually see this whole drama play out in the stock price. Right after the earnings call, the stock dropped on those terrible numbers. But then, about a week later, they announced the successful pricing of that new CLO, real tangible progress on their plan. And what happened? The stock shot up over 6%. This tells you everything you need to know. The market hates the current results, but it's willing to reward them for hitting milestones on that financing pivot.
So, all of this sets the stage for the next couple of quarters. This is where the rubber meets the road. It's basically going to be the final verdict on whether this whole strategy was brilliant or a bust. So if you're following this story, here's your checklist. These are the things that matter. Number 1, how fast do they get that new CLO fully ramped up and start redeploying that capital? 2, watch the sales of those REO properties. Can they get good prices? 3, we have to see that net interest income number start to tick back up. 4, they've got a chunk of debt coming due in 2026. What's the plan for that? And finally, something I always look for, are insiders buying the stock? If they really believe in the plan, they should be putting their own skin in the game.
So to wrap this all up, our thesis is what we're calling the painful pivot. Lument is taking its medicine right now. They're accepting terrible earnings in the short term to get their house in order for the long term. The strategy itself, it's actually pretty sound. The big question is all about execution. Can they pull it off? Because right now, the market is pricing in a whole lot of no.
So when you weigh that high execution risk against the potential reward if they get it right, we're landing on a rating of market perform.
Look, the turnaround story here is definitely plausible. If they nail it, there's some serious upside from where the stock is trading today. But the path forward is incredibly narrow. It's like walking a tightrope. Any little misstep, a bad asset sale, slow capital deployment, and the market's worst fears will come true. For now, this is one you watch closely from the sidelines.
And as always, remember this is not financial advice.